This is the video demonstration for adjusting entries. And in this video, I'm going to be working the solution to example number 2. In this example, it says the Baker Company uses an annual reporting period that ends on December 31st. So basically, they're using a calendar year. And it says the following information concerns adjustments on that date. And then we have a series of adjustments. Looks like about 6 different adjustments there. And on the requirements, they want us to prepare the adjusting journal entries. And then second, they want us to prepare any necessary subsequent journal entries. And we'll probably have to do that potentially on maybe a couple of these. So in this case, we're going to be doing journal entries. So again, I'm going to use Excel, just like I did in the last video demonstration, to do my journal entries. But you could do these on paper, or you could use Excel. It's really up to you. But for each one of these situations, I'm going to record a different adjustment. And once you've had the practice of looking at the previous video demonstration and the homework assignment, you're hopefully becoming a little bit more accustomed to doing journal entries and understanding the debits and credits. So this very first situation here, it says that the office supplies started off the year with a $4,000 balance. During the year, an additional $12,550 was purchased. At year end, a physical inventory shows $3,250 remaining. So in other words, they started off with $4,000. That was a beginning balance. They added an additional $12,550, but then they only had $3,250 remaining. So that requires an adjustment for the supplies. Now, this is going to be as of December 31st. And we're going to record the supplies adjustment. We talked about this adjustment in our video lecture. As the supplies are used up, they become an expense. So what I want to debit is, I want to debit supplies expense, and I want to credit supplies. Because by crediting supplies, it shows that the asset has been decreased. We've used up the supplies and they've turned into an expense. But I also have to figure out the amount. Now, this is going to require some calculations, and that's why these adjustments are sometimes a little tougher than the journal entries that we did in a previous video, because these adjustments, I'm going to have to figure out what to do here. I'm going to have to figure out the balance. So think about it. According to that information, they started out with $4,000. It says they purchased an additional $12,550. So that means altogether, what do they have in total supplies? $16,550. But then it says there was $3,250 remaining. Well, if there was $3,250 remaining, that means that that portion of the supplies were not used. So the beginning balance of $4,000 plus the additional purchases of $12,550, that gives me $16,550, minus the supplies that are left, because if they're left, they haven't been used. That leaves me with $13,300. So I'm going to do this journal entry for $13,300. So that's why these adjustments are sometimes just a little bit more challenging, because we have to think about what we're doing here. We're making an adjustment so that the account will have the appropriate balance. The next situation says the company prepaid $24,000 for a 24-month insurance policy on January the 1st. Well, this is pretty much a classic prepaid insurance adjustment. We talked about this type of adjustment in our video lecture on adjusting entries. The prepaid insurance expires over time and turns into an expense. So I actually want to debit insurance expense and credit prepaid insurance. That's always the appropriate way to settle this type of adjustment. Because think about it. The asset is decreased and it turns into an expense. So I debit interest expense, credit prepaid insurance. The question though is how much? How much? Well, think about this. Go back and look at it. It says they prepaid $24,000 for a 24-month insurance policy. That means they paid for 2 years in advance. This happened on January the 1st. Well, it's now the end of the year. So the entire first year of insurance has expired. So if this is for 2 years, we want to half that amount. So half of $24,000 is $12,000. So I'll book a $12,000 adjustment for that one. The next situation says the company has 10 employees. They earn a total of $2,500 in salaries every working day. They are paid each Monday for a 5-day work week ending on the previous Friday. December 31st happens to be a Tuesday, and all 10 employees worked the first 2 days of that week. They're not going to be paid again until the next payday, which won't occur until Monday, January the 6th of the following year. So in a situation like that, we're going to have to accrue some payroll. And I also want to go back and change my dates. I realized that by default, it dated these as 2013. So it doesn't hurt to go back and fix that. But on December 31st, I want to accrue this pay. Now, how do I accrue payroll? Well, it depends on if they are paid a salary or wages, because I either want to use salaries expense or wages expense. Now, in this description, it said $2,500 in salaries. So that tells me I better use salaries expense as the debit. But I'm not going to credit cash because I haven't actually paid for this yet. So to accrue the salaries, I'm going to credit salaries payable. So that's the proper way to do that accrual. Now it says in terms of the amount that all these employees together are entitled to $2,500 each day. And it says they work 2 days, Monday, Tuesday. So that's going to be $2,500 doubled, or $5,000. So that's the proper way to accrue that payroll. And later on, we're going to have to come back to that particular transaction because that's going to be one of the ones that will require a subsequent journal entry. Because remember, it said in the problem, they want us to do, number one, the adjustments, but also any necessary subsequent entries. Well, this one will require one because on January 6th of the following year, that's when they'll finally be paid. So we will do that one later on. Now, the next situation says the company purchased a building on January 1st for $832,000. It is expected to have a 30-year life and a $22,000 salvage value. Now remember, when we purchase buildings, we talked about this. Those types of assets have to be depreciated. So we're going to have to record the depreciation on that building. So again, 12/31 of 2013. Now we talked about this in our video lecture. Every time you record depreciation, you always debit depreciation expense and you always credit accumulated depreciation. Those are the titles that are always used and always in that order. Now we also talked about the fact that there are different ways to calculate depreciation. And later on in the class, we're going to learn all those different ways. But for now, we only know one way, and that was the way we talked about in our video lecture on adjustments, straight line method. So the formula for straight line is cost minus salvage divided by years. So I'm going to go off to the side and do this calculation. Now the cost of this equipment, they gave that information to me. It was $832,000. The salvage value was $22,000. That was also given to me. So cost minus salvage value is $810,000. We want to divide that by the years. Well, it happens to be 30 years. So we divide that and we get annual depreciation, $27,000. So I will record $27,000 worth of depreciation. And like I said, later on we'll learn other ways to record that as well.